The other day, a friend of mine asked me something. If I gave you $100 right now, would you be happy? I said, of course, it's free money after all. Then he said, what if you lost the $100 you already have? Right there, I got a bit confused. Because the pain of losing is much greater than the happiness of winning. In reality, it's the exact same money, $100. And that is exactly what we are going to talk about today. Our brain's most dangerous, most expensive mistake regarding money, loss aversion bias. And I am 100% sure that you have made this mistake at least once too. You just probably didn't notice it. If you watch this video until the end, you will both see how this bias manipulates you and learn how not to fall into this trap the next time you spend your money. I'm Finn, and on this channel, I talk about ways to manage money more smartly. I tell the facts instead of using complex words. Today's topic is a bit different because this time we won't talk about numbers. We'll talk about your brain. In 1979, two psychologists, Daniel Kahneman and Amos Tversky, conducted an experiment. They presented people with two options. Option A, win a guaranteed $50. Option B, a 50% chance to win $100 and a 50% chance to win nothing. Actually, when you look at it, these two are completely the same. The expected value in both is $50, but the vast majority of people chose A, meaning the guarantee. Then they reversed the same experiment. Option A, lose a guaranteed $50. Option B, a 50% chance to lose $100 and a 50% chance to lose nothing. This time, most people chose B. They took the risk, just to reduce the loss. There is a contradiction here. We avoid taking risks while winning, but we run to take risks while losing. The same person, the same logic, but completely opposite behavior. Why? Because our brain feels losses psychologically twice as strongly as gains. In other words, the negative weighs heavier again. This is called the loss coefficient, and research says that the pain of a loss is approximately twice as much as the happiness of a gain of the same size. This has three concrete consequences in your financial life. First, holding on to the losing stock. You bought a stock, its value dropped. Maybe you're thinking about selling, you're panicking, but you don't sell because selling makes the loss real. If you hold on to it, you can still say, maybe it will recover. This comforts your mind but melts your wallet. Second, selling the winning stock too early. When one of your stocks gains value, you sell it early out of fear of losing that gain. Whereas, if you held it long, you could win more. But your brain is so obsessed with the possibility of losing something that you sacrifice more of your gains just to secure the gain you have in hand. Third, taking no risk at all. The old school mentality, meaning the let my money stay in my pocket perspective. You are so afraid of losing that you never invest at all. You keep the money in the bank or even under the pillow. But there is a loss you forget here. Inflation. Money that doesn't move melts away silently every year. While you think you are safe, you are actually losing a little bit every day. You just don't see it because the number in your account doesn't change. Let me tell you a real scenario. You bought a stock in 2021, you paid $100. Its value dropped to $60. Now there are two options. Option 1, sell, lose $40, put the money into a better investment. Option 2, hold, wait thinking, maybe it will go back to $100. As a result of research, a large portion of people choose the second one, because selling means accepting the loss. Holding, on the other hand, means still carrying hope. But here, instead of saying, how much did I lose? Ask yourself this question. If I were starting over today, would I buy this stock again with this money? If the answer is no, you need to correct the future decision, not accept the current loss. The money you invested in the past is no longer yours. That money is gone. What matters is where the money you have will go from now on. In economics, this is called the sunk cost, and it goes hand in hand with the loss aversion bias. When the two combine, they can keep people in bad decisions for years. So how do we manage this bias? There are three practical methods. First, write down decisions in advance. When you buy a stock or investment, set a rule beforehand like, if it reaches this level, I will sell. For example, if it drops 20%, I will sell. Or, if I see this news, I will get out. Before emotion kicks in, your brain has already made the decision. Second, ask the question, what if I started from scratch? Ask yourself this question every time. Would I make this investment again with this money today? If the answer is no, correct the future decision. not the past loss. Third, normalize small losses. Loss in investing is a part of the game. Even professional investors lose 40 to 45% of their time. The difference is this: they don't look at every loss as, oh no, I'm ruined, this is a disaster. They see it like a data point. If you accept small losses as normal too, you will avoid big mistakes. Meaning, don't expect to win constantly without losing, my friend. The even more interesting part is that this trap does not only appear in stocks. In our daily lives, we are exposed to this manipulation every single day without even realizing it. The marketing departments of big companies know very well what our weakness is. For example, why do almost all applications and platforms give a 30-day free trial period? To do you a favor? Of course not. The purpose here is to make you ownership that product. You use the application for those 30 days. You make it a part of your life. When the period ends, your brain does not see the money, which is the subscription fee, as spending. It makes the payment to prevent the pain that losing that application will create. In other words, you open your wallet not to win something, but not to lose what you have. Let me tell you that phrases like buy now, don't miss out, last 2 products, last 3 hours before the discount ends, are all psychological triggers designed to trigger that primitive fear of losing in your brain. My advice to you is that you have to completely change your relationship with money. Being rich does not just mean earning a lot of money. It is about how much you can control. Disable your emotions while spending the money you have. When the fear of losing takes over you, you actually kill your growth potential as well. The road to financial freedom is not about never making mistakes, but about minimizing the cost of the mistakes you make. Remember, if you take no risks in this life, you actually take the biggest risk. Because the world is changing, inflation is melting your money, and you just sit and watch. This marketing tricks are not limited only to subscriptions, my friend. Even in the supermarkets you go to, this tactic targets your pocket. For example, when they say a $20 discount for a $100 purchase, your brain perceives this as a gain and does not get very excited. But when the same market says, if you do not make a $100 purchase, your $20 coupon will expire, things change. Look at the time. Mathematically, both scenarios are completely the same. The money coming out and entering your pocket never changes. But in the second scenario, your brain sees the risk of losing the coupon, and just not to lose that $20 makes a $100 purchase that it does not need at all without blinking an eye. They even do this in the real estate sector. First, they show you a rundown house with a very exaggerated price. Their purpose is not to sell you that house. It is to show the next normal house you will see as an opportunity you should not miss. After seeing that terrible house, the second house looks like a reward to your eyes, and with the fear of, if I do not make an offer now, I will lose this beautiful house, you immediately tie the money to the house you would normally bargain for. So, as you understand, the capitalist system does not want you to make any decisions. It feeds on your pain of losing. Moreover, this situation not only affects the cash in your wallet, it also steals the most valuable capital of your life, namely your time. Because of the loss aversion bias, people rot their years away in relationships that should end and consume their lives in jobs where they are unhappy. Do you know why? Because if you resign or end that relationship, you will have lost the efforts you made and the time you spent in the past. Your brain whispers to you from inside, Finn, you have been in this company for 4 years. If you leave now, what will happen to your seniority and effort of all these years? Here, this voice is the very embodiment of the sunk cost fallacy. The saying, no matter where you turn back from a loss, it is a profit, was not said for nothing, but our brain is biologically hostile to this proverb. It sees turning back from a loss as a defeat and pain, whereas every single day you continue to stay in that unhappy workplace, you continue to lose your future happy days. In other words, you sacrifice your future to save today. So, what will you do? You will accept and normalize losing as a part of life. Even the best boxers in the world take hundreds of punches throughout their careers. The winners of the match are not those who never take a punch, but those who stay on their feet despite the punch they took and do not ruin their plans. Investment is like this, trade is like this, life is like this. If things went wrong in an investment and you need to stop to sell at a loss, do not see this as a loss. See this as an insurance premium you paid to be protected from a bigger disaster or an expense of trade. Just like how you pay rent and pay electricity bills when you open a shop, small losses are your operating expenses when trading in financial markets. The day you pass into this mindset, your hand will no longer shake in front of the screen. You will leave your emotions completely outside the table and move forward like a robot, staying loyal to your system. Give yourself a promise today as you close this video. The moment you feel that pain while looking at your investment portfolio, bank account, or spending habits, stop and ask yourself, is my brain playing a game with me here? Numbers do not lie, but your emotions can always manipulate you. If you have watched until here, congratulations. It means you are now more conscious in your financial decisions than 90% of people. If you liked the video, do not forget to press the like button and send it to a friend who you do not want to fall into this trap. If you are not subscribed to my channel, subscribe right now to learn not just to spend money, but to manage it wisely. In the next video, we will talk about another expensive mistake of our brain. Until then, guide your money with your logic, not with your emotions. Take good care of yourself, my friend. See you soon.